I'm going to bring in our Wyckoff expert, Bruce Fraser. What do you have for us today?
Well, I want to talk about volume, and volume is certainly one of our favorite subjects in Wyckoff land.
Well, volume is very close to my heart. For me, it's a combination, price and volume. So, if price is doing something, but volume's not confirming it, I find it very difficult to rely on just the price. But I'm interested to see what you have to say about volume today.
I'm circling back just to start. I'm circling back to the most recent blog I wrote, and this is a point and figure chart. This is just to add on to your comment.
Okay.
Point and figure chart of the 10-year Treasury yield, and point and figure on yield is pretty slick. It works really well. And so back in 2012, you can see this nice accumulation that formed within the year, and then marked up, and it had a count on the count line here was at 16 or 1.6%, and with a low at 1.4%. The count was to go to 2.9% to 3.1, and it went to 3.036. And so a really nice count, good hit. And then you can see after that in 2013, it's just this long declining trend of interest rates down to 1.35. And then we can see here that there's another accumulation, another count we can take. And so I posted this count up in the last blog, and this counts to 3.15, 3.35, and it went to 3.035, which was 1 basis point below the prior peak in 2013, and made the case that if you look at the vertical chart of this, it looks like a climax. It climaxed up into prior resistance, and it's pretty close to the low end of the count. And I'm wondering if we don't get some kind of a pause here, and then maybe an attempt to upthrust into this lower count or into that area. But I believe that there's a very good chance that we've hit the wall here for a while on interest rates, at least on the 10-year. So anyway, I just thought I'd put that up just because you were talking about it.
Okay.
People should play around with these point and figure counts on these yield charts because they're pretty slick. So in here, you've seen, we've all seen these charts before. These are the Wyckoffian schematics. In this case, I'm showing distribution. Keep this one in mind because we're going to come back to Facebook as we get further along here. The distribution schematic number 1 with the UTAD, or the upthrust after distribution. But what I really want to talk about is this mess of a chart, very difficult to see. You don't adjust your set because the chart is very fuzzy, but it's going to serve its purpose because I want to talk about volume. And I've had many conversations through the years with people about volume, and I've had some very prominent people say to me, I don't even look at volume because I can't make any sense out of it. And so I think that Wyckoff is the perfect vehicle, the perfect tool for being able to use volume appropriately and be able to make sense out of it. And so the notion with volume is that it's situational, and volume works in context to where you are in the cycle. And so if you just look at volume and you expect it to behave in the same way no matter where you are, whether you're in an uptrend or a downtrend or trading range, it's going to be very difficult to make sense out of it. But if we put volume in the context of where we are in the cycle, then we can start to use it in this contextual manner where we can say, okay, if we're at this point in the cycle, volume should behave like this. If we're at that point, it should behave like that. And so here we're going to use this schematic, which this is very much the Wyckoffian schematic. Dr. Pruden used this chart in a class that he taught where he infused Wyckoff and Elliott wave together. And so you're going to see some Elliott wave counts on this chart, which may be very difficult to read. So don't worry about it. We're not going to talk about Elliott today. But this has the Wyckoff labeling, the Wyckoff schematics in here. And you can see here's distribution, here's the upthrust after distribution structure, and then here's accumulation over here. Okay, now what we need to do is we need to put this in context. And so that's what's going to allow us to turn the key in the lock to volume. Okay, so now what I've done is I've taken and broken down the accumulation into phases, and I've broken down distribution into phases. And when we do phase analysis, which is a very big part of Wyckoff, then we're able to now make sense out of volume, because volume should behave differently in the different phases. And by the way, this chart was prepared or created by Roman Bogomazov, and he did this while I believe he was a graduate student in 1998. We had to resurrect this chart, and it's the reason it looks so hazy. But Roman has just started a new class. He teaches Wyckoff now. He does a wonderful class on Wyckoff, and he's doing a summer session. And he just did the first class this week, and everybody's invited to get a copy of that. Be able to listen to that first lecture, and who knows, you may find that it's interesting to you and you'd like to take the class. So here's his website, and there's their email. So here, the whole notion, we've talked about this in the past, so I'm going to blow through it pretty quickly, is that we have, in accumulation, we have phases. And the process that's going on is that stock in this example is being accumulated by the smart money, who we call the composite operator. And this is the very smart, innovative investor traders that are accumulating shares for a big markup into the future. So you can see here, this is the innovators or the early adopters. And they come in and they basically are absorbing all the stock. And when they absorb the stock, it becomes very scarce. And when it becomes scarce, it becomes difficult to buy for the early majority of investors, which might be institutions and other large buyers. And the stock, because the demand, a little bit of additional demand can just throw the stock into a big uptrend. And so this is really the effect of what's happening is absorption. And phase A, the stock is being held by weak hands. And so the weak hands are basically have carried the stock all the way down through the downtrend. Volume becomes very, very high and panicky. And so we see that, and we can see attributes of that in the S&P in January, February. And so then phase A tends to be a period when volume is high. What you'll notice is that volume tends to be high on the declines, and it tends to shrink on the advances. So here we can see in this example, becomes high on the decline, shrinks on the advances. And so you can see that as this now, volume actually tends to shrink as it gets towards a support area. But we have another rally here, and phase B is this wild and woolly trading range phase. It can go on and on and on. Well, here's the thing that you'll see in phase B. It's very volatile, and you'll see that volume tends to can expand on the way up, but the volatility is very high, and the volume can be high or low on the declines. Here you can see the volume can be high, but the volume also can be high on the declines. And so there tends to be just kind of a wild and woolly situation. But what happens is that when you get into phase C, and this is when we as Wyckofians become involved in the stock, is phase C, phase D, is that the stock has been well absorbed by then. And this phase C is the end of the testing phase and the beginning of the uptrend. And so what we will notice is the volume can be quite high near the lows, but as it starts here on the spring, it's very high at the low, but it's low into it. Here we can see that there's a pullback, which we call a test. And this pullback is on shrinking volume. And look at how low the volume is compared to everything that preceded it. So the volume is quite low, which is evidence that absorption is nearly complete. And then when the uptrend begins, volume starts to expand. And so we can see that the volume is quite good. The bars, the bullish bars are quite good on the way up. And then notice this, as it jumps out of the accumulation phase and then backs up, the volume dries up again. And so this is the pattern we're looking for that tells us that stock is in strong hands, is that the volume is low on the pullbacks, it's rising on the advances, low on the pullbacks, rising on the advances. And the thing is, you'll notice the volume doesn't have to be exceptionally high as you're marking up the stock. And that's because the stock is in such strong hands. It's so scarce, so difficult to own, that it doesn't take a lot of additional volume to propel it higher. And that's one of the things that throws people, is they see volume is rising, but it's not like gigantic, and they think that that is a bearish sign, and it's not. And so in distribution, we see the opposite, and that is that volatility increases as you go through. The volatility on each decline, it becomes larger and larger, and the characteristically, the volume is high at the climax. Volume then stays high on the pullbacks, and it shrinks on the advances. So here we have phase B. We can see that the volume is, we see a rally here up to resistance. Well, look what the volume's doing. Volume is just diminishing as it goes up. That's a very bad sign. Then the volume expands as prices go back down again. Volume, there's a rally up into the upthrust, and right at the upthrust is a big spike of volume, which tells you that the CO is disgorging stock. And then on the decline, volume is high. It's not as high as on the upthrust typically, but notice this rally here, which is a really poor rally, a rally of poor quality, doesn't even get to resistance. And look at the volume in phase, this is phase D. Look at the volume dry up as it goes into that. Very common as you get near the completion of distribution. And then as you outright break down, you can see the volume is very high as you break down. So anyway, those are my comments thematically about volume. And then what I thought I would do is just show an example or two. And here, any questions that came up for anybody? Because I went through that pretty quickly. And my intention is to talk a lot about volume as time goes on, because I think it's such an important part of Wyckoff. But here we have an example with Whole Foods, which this was a blog. This is, you can go back and look at this blog. I was actually personally campaigning Whole Foods. And so you're going to sense some bitterness in my voice, which I'll explain in a minute. But here you can see big markdown. The volume is particularly high on this last leg down. This is climactic, sets up a low, sets up a support area, automatic rally, sets up resistance. So look how well Whole Foods stays pretty much range bound by the support and the resistance areas defined by these two points. Well, the decline down in the secondary test, you can see generally the volume is quite high. So that shows that there's still plenty of supply that needs to be vacuumed up. And it's still very early. We as Wyckoffans don't want to participate over here. We study this. It's over here where we get real interested in becoming active. Now notice this about phase B. Look at the volatility. This is the wild, wild west. This is an area where there's a lot of swings between support and resistance and up thrusts and springing the lows and so on. And this is an area that can really chew people up. It's very important to watch it. This is the area that creates point and figure count. This is where we get the big counts for the big moves, which I'll show you a point and figure chart here in a minute. But notice this, the volume remains high on the declines. You have volume is reasonably high on this rally here, you can see. And then volume is high again on this decline. It's actually expanding. And then this rally here, which produces an up thrust, actually the volume tends to diminish a little bit, which is a bit of a warning that this isn't done yet. And so then you have, again, more volatility and then a big decline back down to support. Now notice this, look at all the volume that comes in right up on these low bars. This is actually has a big element of demand. Every volume bar has got supply and demand in it. And in this case, you can see that there's a spike of volume, but it comes in right on the support. And so this is really interesting to us because could be an important indication that we're completing the accumulation process. Now look at this. Look at this nice volume as Whole Foods jumps. But it jumps up to the middle of the range and then finds supply again. But here, look at the quality of the volume as this is a really good example of absorption being near completion. Look at how this decline is much longer than the declines that preceded it, and it doesn't go nearly as far. It's in the bottom half of the range, but look at how the volume generally is quite low, and it takes a long time to move back down to the support area. And then we have this turn where we have these beautiful big bullish bars with high volume. And this tells us that we've completed phase C. This has tested this. And now we're starting to really launch Whole Foods up and out of the accumulation area and into an uptrend.
Hey, Bruce.
Yeah.
Is it beneficial to have a consolidation phase like that, or accumulation phase that lasts a year and a half?
Oh, absolutely. Not uncommon. It's just not uncommon to have them last they can last 2, 3, 4 years.
Okay.
As a matter of fact, what they do, Tom, is they build bigger point figure counts when they do that. The whole trick to it is to be able to tell that there's real accumulation going on and it's ready to start to mark up. There's some stocks where the charts just go into a trading range for a long time. Well, the lights are on and nobody's home. There's no accumulation. There's no CO there accumulating the stock. Just nobody cares. And but in what we're looking for is we're looking for the conclusion of this accumulation process, no matter how long it takes. And we get these big counts, and then when the stock changes its character, notice the change of character and how it just these big bars. This is that example we were talking about once the demand jumps a little bit and all the stock's been absorbed, that it moves easily and effortlessly, and you can really see that in the bars here. And these are weekly bars. So here, and then look at this backup after it jumps out. Look at the volume just dry up. There's just no stock for sale. It's all been absorbed by very strong hands that intend to sell it at much higher prices. Now, the part that makes me bitter is that it got bought out here. So this is Amazon bought Whole Foods right here, and that's the reason for this big jump. Is that they effectively bought the stock around $42. And this point and figure count over here counted up to $73 to $78. And so this actually was a really, a great acquisition by Amazon, because they effectively bought a company that had the prior high, which was $62. Well, this point and figure chart argued that it was going to go above the old highs, and Amazon was able to acquire the whole enterprise for $42. So this, I think, was a really smart acquisition by Amazon.
Did you file your claim for the other $30?
I did, but I haven't heard back.
I'm sure it's in the mail.
So anyway, so this is a blog. You can go read this, but this happens all the time, by the way. And so, and I've had it happen before, and it never makes me happy. So anyway, so this is how this works. This is how we put volume in context. And if we pay attention to volume and price bars together, we can sort this out. And here's another example. Now, this comes with a big warning, and that is that earnings are expected today in Shake Shack. But I'd like you to, as a group, to study it as a case study. So I don't believe that it's appropriate at this point to try to jump on this ahead of earnings. But maybe after earnings, we'll see. The other part of this is that we have a market that really is pretty weak. And so this is not typically the time that you would be looking to jump into a stock. You want to jump into a good stock when the market's ready to mark up and propel the stock higher. So this is a little bit out of sorts with what the market's doing, but it's still a good case study. So here, big downtrend. You can see, look at the volume come in on the break here off the automatic rally. So there's a lot of supply present. And you can see over here into the secondary test in phase B, you can see now that it took a long time to get down to support, and the volume is drying up, which is constructive. The volume comes in on this jump, but it only gets up to the midpoint of the range, and then another long decline with volume coming in towards the end. This all looks, especially with volume coming in at the very end, it looks like there could be accumulation at work here. Look at this bar, big bar, big down day, but it comes near support, and we wouldn't buy this bar, but we would then look. Whenever you get a big bar like this, you always expect follow through in the days or weeks that follow. But look at this, the follow through that comes takes prices lower, but look at how little volume there is down here. So there's very little supply left in this. And then look at the change of character. Change of character is that there's this really nice rally, persistent rally up to and through the resistance area. Volumes expanding. Look at the expansion here through this. And then an attempt to come back down into the midpoint of the range. Volume is relatively high, so we would be somewhat concerned about this. But if we entered here or on this pivot, we would just let our stops do the work. But now notice this. This is maybe a bit of concern. Is we've rallied up to the sign of strength. We're back up to this high again. Look what the volume's doing. The volume, this volume was pretty good, but then after that, each of these up volume days is coming on diminishing volume as it goes up. Still, it's acted quite well. So what we'd want to see is any kind of a backup or pullback to come and have volume diminish as it's doing that. Here you can see these two down weeks come on very low volume. So that's constructive, very constructive. This pause week here comes on very low volume. And so now we're out. So anyway, again, this is don't jump ahead of this one because earnings are coming, but it's going to be a very interesting one to study. And I do have a small position in this, so just full disclosure. But it's a great case study, and it'll be interesting to see what happens. So I want to show kind of an interesting chart type, and that I think is just very cool. Dick Arms was a dear old friend of mine. I've known him forever. Passed away recently. We really miss him. Brilliant. He always considered himself to be a Wyckoffian. And so you can see here that Under Armour is a very interesting chart, and I encourage you to go study that. And I do have a little position in Under Armour, but the chart that I want to show you is just to I show every chart I show really is just price and volume, but I am kind of an indicator junkie. and Chanel got me all excited about Keltner channels, and so I started doing Keltner channels, which I really love because they really show climactic moves. You can see, but now this is Dick Arm's candle volume, and these are candle volume charts, and they are so neat. They are so much fun because, and I actually saw, the first time I saw this was 30 years ago, and he came and gave a class for Hank, and that's when I first met him, and he talked about this. Well, since then, these are actually candles inside the boxes. So you'll see a box, you'll see the tail, you'll see the body, and so on. But there's another attribute to this that's so interesting, and that is, look at the width of the bars. They're variable widths. Well, the widths are a function of the volume on the day. And so you can see here that this is a very wide bar of gap day, very wide, huge volume on the gap. I'm sure it was news related. And so you can see the volume changes in the bars by their widths. Very narrow bars are very low volume days. So look at this, you can see this decline here is coming on very narrow volume widths. And so the declines are coming, but there's no effort behind them. So here you can see a huge amount of effort over here on this climax, and it went below the Keltner channel and set up an important low. So anyway, I encourage you to go look at these and fuller, because I think they're really telling. Here, this is a really great example of a pullback on no volume. Look how narrow these bars are. So the down, 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 narrow, narrow, very narrow, no effort behind the decline, and in fact, it makes a higher low and it turns back up, and now we're back up to the top of the trading range. So anyway, so love these charts.
I'm trying to get my arms around it.
Yeah, you got to really study them. Yeah, you got to get your arms around.
You got so much going on in this chart right now.
Oh, isn't it something? This is the S&P 500 back here. Just so you know, this is the S&P, and these are just price bars, volume bars, and then this is relative strength and scooter. But anyway,
please, no more, no more.
Anyway,
Uncle, but we do need to wrap up. I want to say thanks, Bruce, for coming on again. Oh. Always a pleasure having you on here. You've always got great information for us.
Well, what a wonderful day. Thank you both very much. Thanks.